Well, hello there and welcome to module number 6. In module number 6, we are going to be talking about joint venture deals. In lesson 1, we're going to talk about all the different ownership structures that are available to us out there. Lesson 2, we're going to talk about the ownership percentage. How are we going to break this up to make it fair for everyone? Lesson 3, we'll talk about raising capital, how we can do this. Lesson 4, we'll talk a little bit about some marketing. So let's get started with lesson 1. How should you actually structure your deal? Well, should you buy and invest it in your own personal name, or perhaps within a partnership or personal names as well? Or create a corporation and sell shares? Create a corporation in itself to hold the title for yourself? Or do a joint venture agreement? These are all different options available to us, so we'll go through the process to determine what's best for you. Alright, so the easy answer is it truly depends. Now, what is it going to depend upon? Well, quite simply, it's going to depend upon you and your plan. You need to have a very clear picture of what it is you want, where you're going. It's also going to be dictated by your place of residence and where your investments are located. Also, your tax position, how you want to position yourself for the best tax benefits. Your necessity for litigation protection, as well as your budget. So let's talk about your plan first. What you need to know and understand is how many properties or doors you will own. If you're only going to own a few doors, 3 or 4 properties, then maybe a corporation, for example, isn't the way for you to go. However, if you're going to have many doors, a corporation would be a direction you want to consider. So these are the types of questions you need to ask yourself. How many partnerships are you going to have? Is this something you're focusing on doing yourself, or are you going to have to do the first couple deals yourself, then start bringing in partners, or are you going to bring partners in right from the very beginning? How long do you plan to hold all of these properties? Are you doing a combination of flips and lease options, or are you strictly doing buy and holds for 5 to 10 years or longer than that? How or when will you exit? Very important, so you can mitigate your taxes. Are you planning on creating a portfolio that you can pass on to your children for an inheritance? If so, then you may want to structure it very differently so that you can avoid your children having to pay taxes. Where do you plan on investing and residing? So, for example, if you're a U.S. resident investing in Canada or vice versa, Canadian investing in the U.S., there's implications for cross-border investing. You've got two tax bodies or tax governing bodies that are going to try and collect tax from you. So they do work together, so you will avoid the double taxation, but you need to set your investing up correctly in order to avoid any conflict between the two countries and their different policies. Even within the same country, whether it's the US or Canada, if you're investing in one state or province while you live in a different state or province, that in itself can create some complications as well from taxes and accounting perspective. So you want to make sure you have a clear picture of where it is you want to invest, and share that with your accountant. From a tax perspective, again, taxes, the tax rates and what is taxable, how it's taxed, will vary from state to state or province to province. Also, different corporations may have different tax structures within them for tax savings. Income within corporations can be taxed according to the source. So, for example, active income is taxed at a very lower tax rate than passive income, and real estate rental income is considered to be passive income. So inside a corporation, it's going to be taxed at a very high rate. So these are all things that you need to take into consideration. Your personal tax rate may be lower or higher than the corporate tax rate. You need to understand that to make the decision. Taking money out of a corporation for your personal use, how can you do that? There are ways of doing it, but what is the best way to do it in your situation? So this is why you definitely want to speak with your accountant, who will know and understand your plan, but you need to make sure that your accountant is also familiar with real estate investing as well. Litigation. Litigation always seems to be top of mind for many people because the more properties you own, the more opportunity there is for litigation against you. You're dealing with tenants and a lot of people passing through your properties, so there's potential risk of people experiencing a fall or an injury on your property. So you want to make sure that you are protected. So what is the likelihood of being sued? Well, if you are investing in Canada, the likelihood is pretty low. There are litigation suits out there where tenants are suing landlords. However, the number of cases are low and the settlements are considerably lower as well. In the U.S., that's a very different story, unfortunately. There seems to be a different mindset with the tenants down there. They see an opportunity to get a free paycheck from the insurance company. So there's a lot more opportunity for you to experience litigation in the U.S. market. Therefore, you want to make sure you structure your business properly. And with respect to corporations, the corporations within the U.S. market are very different than they are in the Canadian market. So in the U.S. market, they do have structures that will help mitigate the litigation and protect you so that you don't lose your entire portfolio, for example. However, in Canada, the liability insurance appears to be more than adequate to cover most, if not all, cases here in Canada. I would suggest a minimum $2 million. I think most lenders will be looking for a minimum of $2 million liability. It's not that much more expensive to increase that up to 3, 4, or even 5 million if you are of concern for that. Another litigation deterrent, and this goes across the board, doesn't matter what country you're in, is to maintain high debt service on your property. Because if a tenant happens to fall or get hurt, or somebody on the property gets hurt and they are looking to take advantage of the fact that you are this rich landlord, whether you are or not, doesn't matter, that's the perception these people will have, then what the lawyer is going to do, representing this individual who's suing you, is they're going to take a look at the assets that are in the corporation or in your personal name. And it doesn't matter the size of the asset. If it's virtually leveraged to 85% or as high as you can get it, and it still is able to cash flow, then there's very little equity in there for the lawyer to go after. So that can definitely become a deterrent, and they can say to their client, there's not a whole lot here. We'll try a much smaller suit, which can then be handled with your insurance policy. Then there's your budget, how much you can actually afford. Well, with respect to corporations, the tax filings, each corporation is like a separate entity. So when you file your personal taxes, that's one entity. You then have 2 or 3 corporations, that's 2 or 3 more separate entities. Each one requires a separate tax filing, and you have to file each and every year. So even if there's no activity at all inside the corporation and you have a corporation that's deemed to be active, then you're going to have to file taxes, and your accountant's going to charge you, probably $800 or $900 just to do that basic filing for you. Then there's the accounting aspect and the bookkeeping. You're going to want to have separate sets of books for each corporation so that you can track everything nice and cleanly. Your bookkeeper should have knowledge of the corporate tax rules as well, just so that they know where to allocate different expenses and incomes, etc. From a legal perspective, there's first of all the creation of the corporation, which isn't a whole lot. I mean, you can do it relatively inexpensively. You can even go online and do it. I would not recommend you do that. I would recommend that you make sure you have a lawyer create it and maintain it for you as well to make sure it's done properly, and that it's all done within the guidelines of your plan as well. But again, the legal aspect, there's an initial cost, and then annually you have to maintain the corporate books by having your annual meeting. It's not a big expense from a legal perspective, but they have to insert some paperwork for you. Now, there are just far too many variables for me to be able to determine what is the best structure for you, but it's because it's based upon your needs. I am also not a tax lawyer or a corporation lawyer or an accountant either, so you need to seek out the professional advice of your own lawyers, your own accountants who are well versed in these corporations, especially when it comes to real estate investing. Now, let's just go over the most common ownership structures. There's the joint tenancy, tenants in common, the joint venture, the partnership, limited partnership, and corporation. So let's take a look at joint tenancy first. This is where you share equal ownership of the property. You're both on title, and just think of it as your own personal residence. This is how most personal residences are done. There's a right of survivorship. So this is typically how married couples will own their house. So when one spouse passes on, then the ownership is passed over 100% to the surviving spouse. Then we've got tenants in common. So ownership of land by two or more persons. Unlike the joint tenancy, though, when one of the partners passes away, the interest of that person does not pass over to the other partner. It can be treated as an asset and passed on to that person's estate. So this is definitely used by smaller groups of investors to avoid the costly corporation setups. There's unlimited liability regarding the pooled investment. Tax issues apply to participants' personal income. So any income that comes in will be split between the partners inside this tenants in common structure and added to their personal income. So that's allocated proportionally to each investor's individual ownership interest in that property. Then there's the corporate ownership. It's a form of business organization created by statute law, and it's legally considered as a separate entity. That's what I said earlier. It's its own business. It's its own person. Therefore, it's going to be taxed and treated that way. The corporation would actually be on title. The shareholder ownership is going to be reflected through the issuing of shares. The shares can be bought and sold or transferred. Incomes and losses incurred is absorbed by the corporation, so the corporation has to file its own tax report, and then how that income is directed to the shareholders will affect the shareholders' personal tax holdings as well. So it's a very common type of ownership, but not one that we most likely use. There's also the fact that the individual shareholders can have very little control over the corporate decisions because it's going to be decided by the majority. Shareholders may withdraw funds according to the shareholder agreement. They can take dividends out. Proceeds from a sale of assets are taxed within the corporation. If proceeds are judged as a capital gain, provisions exist to allow the flow of the non-taxable portion of the gain directly to the shareholder. Again, this is getting a little bit too deep, and I don't want to go that deep at this point in time. If you're looking at corporate structure, then you need to talk to your lawyer specifically. Partnership. So this is where two people or more form a partnership. They pool their finances and financial resources in a joint effort to own a property. The challenge with this type of situation is that the biggest challenge anyhow is that each partner is responsible for the other partner's actions. So that if, for example, one partner goes out and borrows against the property, then the other two partners are liable for that debt as well. You see a lot of this in partnership structures that go bad. That one partner gets into some financial problems, they have to file bankruptcy. Well, then that can also spill over into the other partners as well. So there's no clear boundaries between the parties, and I wouldn't recommend that you get into or enter into a partnership. The only way I would really consider a partnership is if I was doing it with a very close friend or family relative. Even then, there are better, in my opinion, there are better ways to create a partnership structure. So when you're in a partnership, each partner must report their share of profits or losses personally on their own personal taxes. I talked about certain decisions must be agreed upon by the partners regarding partnership reporting, such as capital cost allowance. So for example, if you're going to take advantage of the capital cost allowance, one partner can't say the building's worth $200,000 and the other one say it's worth $300,000. They both have to mutually agree on the capital cost allowance value. Yeah, that's it for that one. All right, so limited partnership. This is a little bit better because with a limited partnership, what happens here is that there's one individual who takes control of the transaction, the deal, the business, whatever the case may be, and that one person is liable for all the debts, and then all the other partners have a limited liability to it. So it's a little bit better. As it says here, it falls legally between a partnership and corporation. Limited partners have limited liability. Profits are passed directly to the investors, similar as in the partnership. Income tax liabilities are imposed on the investor. Now, with a joint venture agreement. A joint venture is a project undertaken by a group of investors in which the parties share in the project, including any benefits and losses. It involves a pool of resources and an undivided interest. No specific portion of the project can be assigned to individuals within the joint venture, which makes this difficult. And if you want to exit the joint venture agreement and sell your share to somebody else, there is no share to actually sell. Difficult to use the undivided interest as collateral. So if you have a joint venture agreement on a property and you want to borrow some money and you don't have any asset to borrow against, it's difficult to use your property with the joint venture agreement because there's no clear defined percentage as to what you actually own here. All right, so let's just take a quick summary of the different structures. The joint tenancy, used commonly for home ownership with your spouse. The tenants in common, this is the ideal for small groups. Equity ownership passes to family, taxed according to share of the equity ownership. And this is the structure that I use along with a co-tenancy agreement. And the co-tenancy agreement simply states what everybody's roles and responsibilities are within the group of investors. Joint venture is usually used for a larger transaction, but the term joint venture is commonly used to describe the tenants in common relationship, which I just explained in the earlier slide. Partnerships, all parties share the risk with no real protection from their partner activity. The limited partnership, one individual takes the lead and responsibility. Sounds good, but banks aren't too fond of this as well, simply because when the banks see that there are multiple partners involved, first of all, they see that as a potential nightmare if and when the property ever goes into a foreclosure status or they're being forced to sell. One of the partners want to vacate the deal. They see a lot of challenges with that. And the other thing is that the banks like to have as many people guarantee the mortgages as possible. So if they have a group of 10 investors in a limited partnership but only one is taking the lead and the responsibility, well, they would like to have all 10 take responsibility for it as well. So the banks aren't too fond of it. Then we've got the corporation, and there's a variety, many different types of corporations, especially in the U.S. market. Banks, again, don't like lending to corporations simply because in the past, a lot of individuals have used corporations as a level of protection for themselves. And if the property or business goes into financial distress and they have to file bankruptcy and it's within a corporation, then the banks don't have as much leverage to get their money back. And so the banks are starting, well, in Canada, the banks don't like lending to corporations, period, unless all of the shareholders in the corporation, or the people responsible, high-level shareholders, they go on the title for that property as well. They're guaranteeing the loan. In the U.S. market, it is starting to change. There are still corporations that have that level of protection so that the banks can't go after the individual. But again, that's going to be changing, or is changing, and the banks are trying to have the individuals guarantee the loans more and more. As I say, different corporation entities between the different countries, so you need to do your research on that. And the corporations can create more cost than what they may be worth, again, depending on what your plan is, how many properties you plan on holding, how you plan on holding them and dealing with them in the future. Is it short-term holds, long-term holds? So you really have to sit down with your accountant and have a good understanding of what's best for you. It may be short-term pain for long-term gain. That's fine, but you need to know that and understand that today, because you can't switch these things over easily halfway through. So, for example, you can't buy a property in your own personal name and then 5 years later decide to roll it into a corporation. Actually, you can do that. However, there's costs of doing it, because you have to create the corporation, and then depending where you reside or where the property is located, there may be land transfer tax attached to that as well. So these are all things that you need to be aware of and understand, but it all comes from creating a plan. It doesn't have to be the perfect plan. It just has to be a plan to get started with that you share with your lawyer and your accountant to understand what is the best structure and ownership structure for you. All right, so that's it for this lesson. Lots to go over and review. So any questions, please feel free to email them at kbeaton@arcarealestate.ca. And of course, we will be following this up shortly with a live webinar to answer questions. So by all means, save your questions for the live webinar. And if you can't wait, go ahead and email them in.